Good day, all. Ira Epstein of Linn & Associates with your SPDR ETF video, and this is your weekend edition, and this is for Friday, April 17th, 2020. Now, what we do on the weekend edition is we're going to look at weekly charts instead of looking at the daily. We'll try to build on that and get an understanding. You already know what the president has done. You know that we have a three-phase deal to get the U.S. economy back to open. States will be making the decisions as to when they think they go into that plan and whether or not they even follow that plan. While it's guidance from the federal government, I'm not sure we control that. I think the state controls that, but at least there's a guidance level. As for the school systems, I know in Illinois they just said it's done. We're through until the next school year. So the kids will be learning on the internet. Yes, the teachers are still teaching, but not back into the schools. As for events, I think you can count. There's not going to be anything going on through at least midsummer. I don't look for arenas to fill up. I don't look for stadiums to fill up. I look for baseball games to be spread apart as much as they can do. Probably not in the stadium you're used to seeing. Everything's changing. As we look at this right now, the market has done what? The president has said it right. The market's looking down the tunnel and sees a glimmer of hope. But we're one of these things. At first, the market, the panic was the COVID-19. Now we're hearing that we don't have any treatment yet. There's hope for some treatments. We don't have a vaccine, but we're going to open the economy. So the market's going to start looking, and it went up, as you can see. But now the reality is going to hit the game also, because that's the euphoria that, hey, that's the light at the end of the tunnel. At the end of that light is going to be a lot of economic news, and it's terrible economic news. And it does not mean that when you flip the switch and we go into phase ones, phase twos, that economy's coming back in the way that you think. There'll be business failures. There's going to be the question, is what the government done enough in terms of giving the money? How are we going to pay for that money? You haven't even heard from the states yet. Illinois, California, New York, these big states, their budgets are destroyed on this. How do they get that all done? There's a mess coming at us, and yet the market is looking at it, and it's all focused on things aren't so bad. I understand the pharma taking off. In fact, new highs on some of the spiders. But the other parts, I just have my own doubts. That's just me. So as we take a look at the technology sector and the XLK, you've had a 2/3 retracement. That's pretty good. That, unlike a 50% or 38, when markets stop at the 38 and they come down, often these lows get tested and taken out. 50% is a bit different. You wonder, can you even get through that low? And when you get to a 62%, it's not a sign that you're not going to get a correction, but it is a sign that that break may not be as bad as first thought. That's how I interpret it. It's my own interpretation, and we'll see if it holds. When I look at the swing lines on the XLK, unless this market gets over 94.66, you still have a pattern of lower highs and lower lows, the definition of a downtrend. I realize that some of you will say, why don't you buy the market down there? And let me tell you what I did say on TV. And what I had friends calling me today, and they said, you know, you helped me. And I go, why? They go, because in the stock market, not futures, stocks, you said nibble, nibble, nibble. Stocks are longer term. You should have a 3-year plan minimum. You're not looking at today, but you always look at the companies that are made up in the spider or the individual company, but that's how that part works. Futures, completely different. Spiders, different than futures. You don't get the leverage here on a typical spider or ETF that you get on a futures. Can you get more? You could if you go to triple inversion, and there's all kinds of things. There's all kinds of products, but typical person, no. As I look at the market, you're still in a basic bear trend. Resistance, the 18-week average. Now, the first resistance, we should look at that. You came down, you stalled at first on right here, the 100-week average. You made a run, didn't quite get to that 200-week, and so many financial TV stations talk about that 200. Market held here, and now we've got 4 weeks of holding that 100. What's it going to do? Well, it decided to pick itself up, and it's making its run at the 18-week. But that still has downside bias, and the trend is down. When I look at the market for Bollinger Bands, they're not in play anymore. What do I mean by that? They were in play right here. When the market first got to it, I think that the first challenge of a Bollinger Band is where the pro takes money off the table, be it on the upside, the first one. After that, there's another rule that kicks in, but the first one. And the market went under it, and then it popped back and it stayed over it. Okay. On the way down, I have first support at the 100-week average, and that's where if the market were to fall here, that I think the pros would be looking at money in between there and that lower Bollinger Band. And you take yourself out of this bearishness if you get over 94.66 and the momentum of the market up, which makes sense. We've had this rally that kicked in right through here, and it's carried the market even further. As we take a look at XLI, I decided to put on for you a Fibonacci count. You're in the 38% area here. That's what I wanted you to see. No more than that. I just wanted you to get a feel as to where you're at. Haven't even made it to a 50% retracement. When we come to the energy sector, you still have a pattern of lower highs, lower lows. Now, the downside momentum has been changed. Momentum's pointing up here. The trend is down, and you break the downtrend if the market just gets up and takes out the 36.46 level, and you're finished up at 33.95. Because what would change? You then could have higher lows, higher highs. You're out of the downtrend. The bias stays down unless you get over 47.05, but that's the number I'd be looking at. QQQ. On the weekly charts, it is not as strong as the dailies. The dailies are much stronger. They've gotten about a 70% retracement already. In this market, we're still with the lower highs, lower lows. So if I'm bullish and want to force the bears out, the number I want to see taken out on this chart is about $3.50 higher. 219.61. It would break that pattern. If I'm a bear, I want to hit this market now and get it back under the 18-day average without getting over that number. It would make the battle zone very clear at that 18-week average, which it was anyways, and it still is. In the emerging markets, this is that pattern that if you broke in the NASDAQ, it would happen. Higher lows. So you came out of your downtrend. When did you come out of it? You had the downtrend all the way through here, lower highs, lower lows. You had been under the Bollinger Band 2 weeks in a row, and then you moved to the right-hand side. But if you take out 54.50, you break the pattern of lower highs, lower lows, which you did last week and you followed through this week. So this market, unlike the others, has a lot of resistance, but no, I'm not going to call it in a downtrend on the weekly chart. GLD, where did the market run into resistance? Where it keeps running into the resistance, the upper Bollinger Band. And I realize that people get crazy bullish gold when you get these moves up, but when you're over a Bollinger Band, the odds of staying over it are 5% of the time. That is not a sign to get bearish. It might be a sign to lighten up. Let the rest of the people out there get crazed. Here you came down, came back up, very wild action, right back down. Now, you can see what's going on. Now, this is your move to the upside. This is April 9th. Now you're getting up to that upper Bollinger Band. You get through it this week and you get thrown back right under it. Have we done any real damage to the chart? No. You still have the higher lows, higher highs. I'm going to look at support this week on the weekly chart, not daily. Daily chart turned bearish because you're correcting right here. 148.97 is the support, and that number will climb when we reopen on Monday morning. In the gold miners, this market is still in the bull camp on the weekly. Higher lows, higher highs. The daily chart ran into the Bollinger Band and other numbers that threw it back. We expected that. This chart is still looking good with support at 27.25. Let's face it, gold at 1,600, 1,700 an ounce is worth a lot more than 1450 a while back, so the reserves of the miners still look pretty good right here. And eventually, that tunnel at the end that the president's talking about where COVID ends, we also, it's a light that tells you the terrible economic numbers are going to be coming out. How do we deal with them? How do we deal with everything we're just through at this market, which I agree we had to do to save the economy? Now what do you do on the next level of saving the economy? That's going to be interesting. TLT, Watch this week's low. If you take it out, when you take out the low of an outside week up, it's often a sign that a bull market, if you're going up like that, is running into a problem where it might get a good size correction. I think that if the bulls are going to keep it, they can't let this week's low of 163.48 be taken out. Then we get to the currency. Well, if you take a look here, lower highs, higher lows. You've gone into a stall. The basics of the market are still bearish because you still have the legacy of the lower high, lower low, but this could be a sign the market wants to make a run at that 18-day average. Assuming it doesn't, if it breaks down here, look for the 101.24 area in the market. What I do for you is I'll start you off, and I put out 2 videos. So this one you're looking at is my morning subscriber for the futures. I mention it because if I'm a trader in SPDRs and ETFs, you think you're not looking at the futures to have an idea what's going on? You have any idea how many of these ETFs own and are based on futures markets? It's quite a few. So you look at that. So I have a morning video that's way more detailed than this. And then in the afternoons, at 4 in the afternoon, I start publishing a SPDR ETF video with specific buy, sell, do this, do that. It looks very different than these. A lot more studies and a lot more information. To find out more about both, just go to our website, look under the word research, just click it, it explains everything. These are inexpensive, folks, meant to stay that way, and that's the goal of them. A lot of teaching. I'm Ira Epstein. You have a good weekend, and I'll see you all come Monday. Take care.